The Revel Casino Hotel opened on the Atlantic City Boardwalk on April 2, 2012. It closed on September 2, 2014. In the 884 days between those two dates, it generated no profit. It generated no operating period in which its revenue covered its debt service. It generated no quarter in which independent observers revised their assessment of its viability upward. What it generated was the most precisely documented case of a capital structure applied to a fundamentally incompatible market in the history of American casino development, and a forensic record detailed enough to constitute a textbook for every subsequent generation of gaming industry analysts who need to understand what happens when a differentiation thesis collides with the structural market reality that differentiation cannot address. The Revel was not a bad hotel. That distinction is forensically important and consistently misunderstood in the popular account of its failure. The physical plant was exceptional. The design by Arquitectonica was among the most sophisticated architectural statements on the Atlantic City Boardwalk. The non-smoking policy was a genuine competitive differentiator in a market that had never offered a premium gaming experience free of tobacco. The food and beverage program was executed at a standard that Atlantic City had not previously produced. The spa, the pool, and the beach club were competitive with luxury resort destinations in markets far more sophisticated than Atlantic City had historically been. None of that mattered, because the Revel's failure was not a product of what the hotel was. It was a product of where the hotel was, and of what the market that surrounded it was capable of generating in terms of gaming revenue, relative to the debt service obligation that $2.4 billion in construction cost had created. The forensic entry point for this case is the relationship between product quality and market capacity, because the Revel documents with precision the proposition that a superior product in an insufficient market produces a superior failure, not a superior outcome. The hotel that was better than everything else in Atlantic City failed faster than most of the properties it had outclassed, because its capital structure required a market response that Atlantic City's structural conditions made impossible regardless of how well the individual property performed against its local competitive set. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The Revel's capital structure combined Morgan Stanley's initial equity investment of approximately $1.2 billion with debt financing that brought the total construction cost to approximately $2.4 billion, making it the most expensive casino construction project in Atlantic City history and the second most expensive in American gaming history at the time of its opening. That capital structure required the casino to generate net operating income at a level that the Atlantic City gaming market of 2012, 2013, and 2014 was structurally incapable of producing for any property, let alone for a property that had elected to eliminate smoking, restrict its gaming floor relative to its physical footprint, and price its hotel rooms at a premium that the Atlantic City market had historically been unable to sustain. The covenant that nobody at Morgan Stanley, at the Construction Lending Syndicate, or at the New Jersey Casino Control Commission read carefully enough was the one written into the total addressable market for a non-smoking luxury gaming property in Atlantic City in 2012. The Atlantic City gaming market had been losing revenue to neighboring states since 2006. Pennsylvania alone had captured enough of Atlantic City's regional customer base by 2012 to reduce the city's total gaming revenues from a peak of approximately $5.2 billion in 2006 to approximately $3 billion in the year the Revel opened. The non-smoking differentiation strategy required the Revel to attract a premium demographic that was not currently visiting Atlantic City, in addition to retaining enough of Atlantic City's existing customer base to cover operating costs, all within a total gaming revenue pool that was 40% smaller than it had been 6 years earlier and continuing to contract. The non-smoking policy produced the specific covenant failure that the differentiation thesis had not priced. The Atlantic City customer base that generated the majority of the gaming floor's theoretical revenue was a customer base that smoked. The premium non-smoking demographic that the differentiation thesis required was a customer base that existed in the northeastern regional market but that had not historically visited Atlantic City, and that the Revel's location on the northern end of the boardwalk, away from the concentration of entertainment and hospitality infrastructure that Atlantic City's central corridor offered, made difficult to attract and retain. At what point does a differentiation strategy become a market incompatibility rather than a competitive advantage? Leave your analysis in the comments below. The appraisal methodology applied to the Revel's construction financing produced stabilized revenue projections that independent gaming analysts characterized as optimistic before the property opened, and that the property's actual operating performance characterized as detached from market reality within its first operating quarter. The projections required the Revel to generate gaming revenue per square foot of gaming floor at a level that no Atlantic City property had achieved in the preceding 3 years. In a market whose total gaming revenue was declining at a rate that made per property revenue improvement structurally dependent on market share gains from competitors rather than on market growth. Market share gains in a contracting market are a zero-sum mechanism. Every dollar of gaming revenue the Revel captured from a competitor was a dollar that competitor could no longer use to service its own debt obligations. The Revel's differentiation strategy, if successful, would have damaged its competitors' financial stability rather than growing the market's aggregate revenue. That consequence was not a secondary consideration in a market where the financial viability of every existing casino was already stressed by the revenue contraction that Pennsylvania and Maryland gaming had produced. A successful differentiation strategy at the Revel would have accelerated the closure of Atlantic City's weaker properties, potentially triggering a cascade of regulatory and financial complications that the market's remaining viable properties would have been required to absorb. The appraisal failed to model that dynamic because the conventional casino appraisal methodology treats market share gains as revenue positive without adequately pricing the market stability costs that aggressive market share capture produces in a market operating at the margins of viability. The Revel's stabilized revenue projections assumed market share gains that were individually achievable and collectively destabilizing, a combination that the appraisal methodology had no framework for identifying as internally inconsistent. Morgan Stanley's recognition of the stabilized revenue projections' inadequacy came within the first operating quarter. The firm began seeking buyers for the property before the end of 2012. The Chapter 11 filing in March 2013 came 8 months after opening. The second Chapter 11 filing in June 2014 came after a failed restructuring attempt produced no viable path to continued operation. The closing in September 2014 came after the bankruptcy court determined that no buyer existed at a price that would allow continued casino operation. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The denial architecture embedded in the Revel's development and operation history is distributed across 3 parties whose individual rational decisions produced a collective outcome that none of them individually intended. Morgan Stanley's decision to invest $1.2 billion in the initial equity position was rational from the perspective of a firm whose gaming industry expertise and financial modeling capacity had identified a genuine gap in the Atlantic City market's luxury positioning. The construction lender's decision to provide the additional $1.2 billion in debt financing was rational from the perspective of institutions whose underwriting of the stabilized revenue projections reflected the standard methodology applied to casino construction lending in 2010 and 2011. The New Jersey Casino Control Commission's decision to approve the Revel's gaming license and to provide approximately $261 million in tax incentives was rational from the perspective of a regulatory body whose mandate included promoting the economic development of Atlantic City and whose institutional incentive structure rewarded new investment rather than market capacity analysis. Each party's individual rationality contributed to a collective outcome that the market data available to all three parties at the time of their respective decisions had characterized as unlikely to produce the stabilized performance the investment required. The market data was not hidden. Pennsylvania's Gaming Commission published monthly revenue reports that any analyst with internet access could read. Atlantic City's gaming revenue decline was documented in the New Jersey Casino Control Commission's own quarterly reports. The demographic research on the Northeastern gaming customers' sensitivity to Atlantic City's location relative to Pennsylvania's more convenient gaming facilities was available in the academic gaming literature that the industry regularly consulted. The denial was not the denial of unavailable information. It was the denial of available information by parties whose institutional incentive structures consistently rewarded the interpretation of that information as manageable risk rather than as structural incompatibility. Morgan Stanley's investment thesis required the data to be manageable risk. The construction lender's underwriting required it to be manageable risk. The New Jersey Casino Control Commission's institutional mandate required it to be manageable risk. The data was structural incompatibility. The property paid the difference. The Revel's physical structure stands on the northern Atlantic City boardwalk as of the time this episode was produced, structurally intact, mechanically operational in its building systems, and commercially inert. No viable redevelopment of the property has been completed in the decade since its closing. The Florida developer who acquired the property out of its second bankruptcy proceeding for approximately $82 million in 2015 proposed multiple redevelopment concepts, including a non-gaming hotel, a mixed-use residential and hospitality development, and a partial casino reopening under various regulatory frameworks that New Jersey's gaming statutes would need to accommodate. None of those concepts has proceeded to completion. The building that cost $2.4 billion to construct has been generating zero revenue for a decade while generating ongoing maintenance and carrying costs that the ownership has been absorbing without a commercial return. That outcome, a $2.4 billion asset generating zero revenue for a decade after its operating entity's closure, is the most expensive monument to a market incompatibility thesis in the history of American casino development. The Revel's post-closure history is, in the forensic framework of this channel, the continuation of the same story that its operating history documented. A property that is genuinely superior to what surrounds it in a market that cannot support what it costs to operate. What the Revel case reveals in the context of this channel's 20-case archive is the specific failure mode of quality in the wrong market, a failure that the channel's previous 19-case files have approached but never documented with this precision. Every previous case file has examined a property whose physical quality was either a genuine competitive asset in a viable market that the capital structure nevertheless destroyed, or a property whose physical deterioration contributed to the financial failure that the ownership's decisions accelerated. The Revel is the only case file in the archive in which the physical quality is unambiguous, the market incompatibility is unambiguous, and the relationship between the two is the entire story, a superior product applied to a market that could not pay for it, by a capital structure that required the market to pay for it anyway. If this case file changed how you evaluate the relationship between product quality and market capacity in hospitality investment decisions, subscribe to this channel because the next case examines what happens when both the product and the market are viable and the failure comes from a third variable that neither the product nor the market generated. And in the comments, given the market data available before the Revel's construction financing closed, what specific underwriting standard would have identified the market incompatibility that the stabilized revenue projections failed to price? The case file is open.